Welcome to Talk Tickers, where we break down the earnings calls that really matter. Today, we are diving into Lyft's Q3 2025 report. Now, on paper, it looked like a miss, but the stock absolutely took off. So what is really going on here? Let's get into it. Okay, so let's just lay it out. The headlines were not great. Lyft missed on earnings per share, and they missed on revenue. By all accounts, that should be a bad day for the stock. But that is not what happened at all. The market just shrugged and sent the stock rocketing up 26% in the 6 days after the call. A huge move. This is what we call a paradox, and it tells you the real story is not in those headline numbers. So that's the big question, right? What on earth did the market see that the headlines missed? Well, it turns out the real story, the one that got investors so excited, had nothing to do with those small misses. It was all about what's happening underneath the surface. We're talking about some serious operational momentum and some big strategic changes. And that's exactly what we're going to dig into right now. All right, let's get into the numbers that actually drove this rally. Forget the headlines for a second because a whole bunch of all-time highs are what really tell the tale here. First off, let's talk about the customers. Active riders were up a massive 18% from last year. We're talking a record 28.7 million people using the platform. Now, this isn't just some number on a page. This tells you the core business, the actual ride-hailing service, is absolutely thriving. People are coming back, and they're using Lyft more than ever. And you know what happens when you get more riders? You get more money. That growth translated directly into spending. Gross bookings, that's the total amount of money spent on the platform, also hit an all-time high of $4.8 billion. That's a 16% jump. It's just simple math. More people, more rides, more money. It's a sign of incredibly strong demand. Okay, but this is the number that really made Wall Street sit up and pay attention. Profitability. For the first time in the company's entire history, Lyft generated over $1 billion in free cash flow on a trailing 12-month basis. $1 billion. This is the game changer, folks. It proves this isn't just growth for growth's sake. This is profitable, cash-gushing growth. And investors love that. And that cash didn't just come from one place. I mean, look at this. They posted a solid net income of $46 million. Which means they're officially, by the book, a profitable company. Then you've got adjusted EBT, which is kind of Wall Street's favorite way to look at a company's core health, and that jumped 29% to a record high. All of this funneled down into that incredible free cash flow number for the quarter, almost $278 million. Just wow. So how are they pulling this off? What's the magic here? Well, it's not magic, it's strategy. On the earnings call, management laid out this incredibly clear three-pillar blueprint for the future. And this is the new story that has the market so fired up. And you can really hear the confidence from the top. CEO David Risher basically said, hey, this isn't just a fluke, this is the comeback story in action. He's pointing to 2026 and saying the momentum is only going to accelerate from here. That's a bold statement, and it's exactly what investors wanted to hear. So here it is. The three-part plan. It's actually pretty straightforward. Pillar 1, just keep crushing it in the core business here in North America. Get even more efficient and profitable. Pillar 2, go global and do it smartly through acquisitions to expand their market. And Pillar 3, and this one is super interesting, get ready for the self-driving future, but do it in a capital-light way. Don't own the cars, just own the network. Let's double-click on that global expansion piece because it's happening right now. They made 2 huge moves. First, the FREENOW deal. Boom. Just like that, they have a massive presence all over Europe. This literally doubles the size of the market they can go after. Then they bought TBR Global. This is a totally different play. It's high-end corporate and luxury travel. Think higher margins, stickier customers. Super smart. And that brings us to the autonomous vehicle or AV playbook. And honestly, this is brilliant. Instead of burning billions of dollars trying to build their own robotaxis, they're just partnering up. They're working with Waymo to manage their fleets. They're planning to work with a company called Tensor to let people put their own AVs on the Lyft network. See the pattern? Lyft doesn't have to own the expensive cars. They just run the network that connects the cars to the riders. That is a way more profitable business model. Okay, so we've seen the record numbers. We've seen the new three-part strategy. It's a whole new ballgame for Lyft. So with all that in mind, let's get to our own take here at Talk Tickers. This is the next call. First, let's look at the guidance. Management isn't just talking a big game, they're putting numbers behind it. For next quarter, they're guiding for gross bookings growth to actually accelerate up to 17 to 20%, and they expect another quarter of really strong profitability. So yeah, they're basically saying this wasn't a one-time thing, get used to it.
So, you put it all together, the incredible operational turnaround, this new, super clear strategy, and the cash just pouring in. For us, it's a clear picture. We are initiating our coverage on Lyft with an outperform rating.
All right, so here's the trade idea. Our whole thesis is that the story for Lyft has completely changed. This isn't about survival anymore, it's about profitable growth. We think the market is still not fully pricing in how much money they can make from these global acquisitions and their clever AV strategy. So the action is simple. We're long LYFT equity. We see catalysts on the horizon, like getting good numbers out of FREENOW and TBR, or hearing more good news on the Waymo partnership. We're setting our price target at $30.
And as always, just a final reminder, this is not financial advice.